webcast is now starting. All attendees are in listen-only mode.
Hello, everybody. Mike Lieberman with Advisors Capital Management here with Dr. Charles Lieberman, Chief Investment Officer of Advisors Capital Management as well. I wanted to thank you all for coming to our webinar, America 2.0, Investing Post-COVID. And really what we wanted to talk about in today's webinar is the idea that various states are going through various ways and approaches to reopening, what that means for markets, how you can go ahead and position client portfolios, what we're doing, sort of what the bigger picture looks like as we start to look at things down the road. And so with that, we might as well just dig right in. Keep in mind, by the way, everyone, that we do have an open question forum. So there should be a question box on your screen for which you can type questions into. We will try to get to them in real time, so to make this sort of an interactive process. So if you have questions about anything that we're talking about, please feel free to type them into the chat box. With that, Chuck, I want to sort of move the conversation right away to the idea that unemployment obviously exploded through the roof. And then last month, or earlier this month, I don't remember when, a couple of weeks ago, there was the job print that came in significantly better than expected, right? Indicating that parts of the economy that were open were seeing traction. Is this sustainable? Was it expected? What sort of happened here, and what's the reasonable expectation looking forward?
Yeah, so good afternoon, everyone. So the timing of that report was a little bit of a surprise. Most Wall Street economists were expecting another large decline because they were being driven by the weekly unemployment claims, which were still rising at a pretty rapid rate, even though they were decelerating. So there's still a lot of people who are filing for unemployment insurance. But at the same time, we all knew that beginning in, let's say, late April, early May, that some states were starting to reopen to some degree. And gradually over the course of the month, more and more states reopened. And so it was clear that the economy was in the process of beginning to recover. And I'll talk about that more later. But the rebound in employment for May was certainly a bit of a surprise, only in timing. I would have guessed that that would have shown up for the June report that will come out at the beginning of July. But the process is clearly underway.
Where would you expect, I've heard plus 3 million, plus 4 million for the next report. Is it going? I mean, and obviously we want to focus there on the right side of this chart. Is that something that's likely? I mean, what are we talking millions, high single digits, mid single digits, low single digits of millions of job gains next time around?
There's a good chance of that. And it's probably in the millions because this whole thing played out with incredible speed. Look at the chart that's there. We went from a 4%, 3.5% unemployment rate to a 15% unemployment rate in the span of a month or two. So the thing just absolutely collapsed. And in fact, the way I describe it in terms of GDP is think about the data that we've already gotten from the government. So we know that in January and February, the economy was performing normally. The first half of March, it seemed to be performing normally. And then everything went over the edge of the cliff around the middle of March, right? So for 2 months, 2.5 months of the first quarter, things were okay. We're doing fine. And then in the second half of the last month of the quarter, everything fell apart. And that was sufficient for GDP in the first quarter to come in at -5%. So that second half of March was devastating. And then, of course, April was shutdowns galore all over the place. And so April had to be an extremely negative number. Well, that's the first month of the second quarter. And partly on the basis of that expectation for April being so negative and it filtering into all of the other economic data, you heard numbers being thrown around about GDP for the second quarter coming in the ballpark of -30%, 40%. huge negative numbers. But, this whole thing is played out very quickly. And so we do know that people are starting to go back to work. And so with, millions who file for unemployment, that could reverse pretty quickly, or at least some of it will reverse pretty quickly. When I think about the second quarter, I think of April as severely negative. I think of May as close to break even or balanced, maybe down, maybe slightly negative, with this employment report, maybe slightly positive, but nonetheless not dramatically far from zero. And then, of course, by June, and we're about halfway through June now, June should be unambiguously positive across the board. Now, even with a positive June and a flat May, April was so bad that we're still seeing numbers projected for the second quarter GDP of ballpark minus 30%. And that seems like a reasonable number to me. It doesn't seem outlandish. But with June being positive, we're entering the third quarter on a clear positive trajectory. And so if the second quarter comes in at a negative 30%, I could imagine the third quarter coming in at a plus 15, a very significant rebound for one quarter, and then decelerating but continuing positive thereafter. So maybe the third quarter is plus 15, maybe the fourth quarter is plus 7, 8, 9. So clearly the economy is in the process of a recovery. A lot of people will get rehired reasonably quickly. Others will take longer. This thing will play out over the course of multiple years. But I think the worst is clearly over. And it's really exceptional in that we essentially had a 2-month recession, but still a very, very deep recession when you consider that it was only 2 months long.
There clearly is some debate, and we already have the first question in, which is great. The $600 subsidy, which was given to the government to those who were unemployed, in some cases paid more people to stay on unemployment than they were being paid. Does that contribute to those numbers? What about that $600 payment running off, material, immaterial, going forward?
Yeah, there's no doubt that it was material. We have a number of anecdotal reports about employers saying that they wanted to rehire people because of PPP, right? They were paid by the government to rehire or to keep their employees on the payroll. And some of those people didn't want to come back because they were making more money from unemployment insurance than they were being paid on the job. So the government recognizes that. That's one of the reasons why they're floating assorted other ideas to try to figure out how to encourage people to go back to work, whether it's payments to employers, whether it's cutting back on payments to people who are unemployed, whether it's paying some sort of bonus to people to go back to work. There are all kinds of ideas like that being flown around. But the bottom line is that we're definitely going to have a strong economic rebound, and then we'll have to see how it plays out, whether it's sustained, whether it slows down, how quickly it unfolds. All of that is really unknown. All
right, so let's take a look at what is known, right? And that is where we're able to see behavior in the United States, behavioral patterns across various different components of the economy start to change. Now, we've heard, no shortage of times that another shutdown is not going to happen, right? Fine, good news. Looks like we're going to have to learn to live with this virus. And with that, as more states start to open, we've seen behavior start to move. So on the screen right now, TSA checkpoint travel. To me, right, the top line is a year ago versus the blue line, which is this year. You can see we went off a cliff. Air travel, Chuck, thoughts?
Yeah, so again, this is a great chart for really laying out what's happened. So you can see that a year ago, when things were normal, we would oscillate between roughly 2 million and 2.5 million people going through TSA checkpoints on a daily basis. Huge numbers and a fair amount of volatility reflecting day of the week, weekend travel versus weekday travel, all that kind of stuff. And then you can see how fast it fell apart. So back in the beginning of March, things are still kind of normal. And then bang, it really just collapsed. And by early April, it was already down to really low levels. Well, here we are. This data is as of a week ago. And you can see we're back to almost 500,000 TSA checkpoints again. So that's anywhere from 20 to 25% of what was normal last year. So a pretty sizable rebound. And this thing is improving literally daily. All the major airlines have all announced that they're putting more aircraft back into the air, which means more people will be flying. And I would expect this thing to continue to trend upward. It'll take a while before things get back to normal, maybe quite a while, because there'll still be people who will be nervous about traveling by air. And businesses, in many cases, are not allowing employees to travel unless absolutely necessary. So full recovery will take a while, but clearly we're already substantially improving.
And that's one of the points I think you're going to hear throughout today's webinar repeatedly is understanding what it is that you own. Because just because flights are coming back doesn't mean the same type of flights that people were taking before are going to be the same type now. And business travel, right, where airlines make a lot of money is a great example of that. Clearly, what we're doing right now, Zoom, all these things, business travel may take a longer time to pick up. So understanding the balance sheet of what you own, important. Chuck, agree?
And yeah, absolutely. And reinforcing that, initially some of the airlines are talking about leaving the middle seat open. So in that case, they'd be flying with, let's say, 2/3 of capacity. So there's no doubt that they're going to make a hell of a lot less money flying at 2/3 of capacity than full airplanes. Back in the good old days of 2019, you got on a plane and it was infrequent that you saw more than a half a dozen seats that were open. That's not going to be true for 2020.
Yeah, the good old days of 2019. Okay. Let's take a look at restaurants, right? What I did was I pulled together here some of the largest states in the country, and to take a look at seated diners, right? And to see what that was looking like, big picture, across all states or all big states. Again, much like the airline pattern, we sold off and went to zero. Now starting to pick up. What does that mean?
So we're expecting that to continue. Just a few weeks ago when I drove around, lots of restaurants were open for takeout only. Increasingly, they're opening for in-site dining. I actually went to a restaurant last week, Friday evening, and we sat with another couple at a table. The number of tables in the restaurant was greatly reduced. And there were lots of vacant tables, tables that were empty, even though it was a Friday evening. But the process is beginning, and I expect a lot more pickup gradually over time. I'm hearing things like, people are going out and they're surprised at how many people there are out there without masks. There are a lot of people who are going around without masks. So, it'll take time. People do need to become comfortable. The data continues to improve for the most part. New York and New Jersey are seeing dramatic improvements in the number of cases. There have been some pickups in a couple of places, but those might be due to unusual circumstances. So I do expect restaurants to increasingly see more and more usage.
Okay, so the thing. Stats appear to be moving in the right direction, right? And then we'll get into a little bit afterward about states seeing more pickup cases for whatever reasons, but gasoline demand. So people are getting back on the road, whether it's gasoline or jet fuel, whatever it may be. People are getting back on the road, right? They're in motion. Again, thoughts there?
Yeah. So the interesting thing here could be that gasoline demand could actually exceed the prior peaks. One of the things that we've discovered with this pandemic is that public transportation is a riskier place to be, whether it's buses or subway cars or rail cars. Those are in closed places. People are more at risk of catching the virus from fellow travelers, fellow passengers. So the risk is that more people will drive to work, and that will actually increase gasoline demand. It's already back to levels that are not far below what we would consider to be normal. So it could easily be, and this data, by the way, is a month old, or at least 3 weeks old. So I expect more gains here, and this to really get back to normal pretty quickly.
All right, and then lastly, mobility, right, from Apple. Mass transit, like you said, clearly the slower to recover, right? But walking and driving, you're seeing well pick up. Supports more of the case you're making, right? Supports more of the idea that people are going to be driving, walking. What are the ramifications here, though, for, and I think it's stuff that most people know, but the idea that, people may not be so willing to go back to work in a large office building.
Yeah, and we've wrestled with exactly that question even for our own firm. So we've been working from home for quite a while, basically dispersed. It must be 2 months at least. June, May, half of May, half of April. So more like 3 months already, because we dispersed fairly early in this process, and the firm is functioning sufficiently well that we feel under no pressure to reopen the office any sooner than we have to. So right now, our guess is that we will not reopen our prime office until probably Labor Day, maybe beyond that. And I suspect there are a lot of firms out there doing something like that. So it's interesting that driving and walking requests for GPS information is already essentially fully recovered. It's almost shocking that it's fully recovered. But I kind of expect that offices will take longer to reopen. This is going to be drawn out at least a little bit over time. And we're not going to get an overnight recovery in the economy. It's going to be spread out. The good news is that some rehiring will take place pretty quickly. And that provides a nice impetus or nice push for economic growth on a broader basis. And as things reopen and people get rehired and start spending more money, that also positively affects other companies. So I think it becomes self-reinforcing. So I have no doubt that there's an economic recovery underway. I have no doubt that the initial stage of that economic recovery is going to be quite strong. And then we'll have to see how it plays out beyond that. That's where the uncertainty really starts to increase.
Well, but the thing is, right, on the screen here, you can see here's how it has played out stock market-wise. And what we've seen in just the previous, couple of slides is that airlines are getting better, but it's a different kind of better. It won't be the way it was. Restaurants are opening, right, but at limited capacity. People are driving because they're uncomfortable with public transportation. And with that, less people are going to work. That impacts office buildings. There are a lot of investment ramifications on the individual position level, right, that don't show up in this picture, that don't show up in this year-to-date change in the S&P 500. So is this a scenario, right, where maybe a rising tide does not lift all boats?
Absolutely. And in fact, the tide has very different effects in different industries. When I look at this graph, and I hear people talk about this all the time on CNBC and Bloomberg, how strange it is that the unemployment rate is so high, approaching 20%, and yet the stock market is not that far away from its previous peak. And how is it that the stock market could be so high, and yet the economy is still obviously, clearly, still in quite a recession? And the answer is that the market looks ahead. So look at the previous peak back in February of this year. So you can see the stock market was doing quite well and had been doing well for a while, and then fell out of bed. And the interesting thing is it collapsed. The collapse began before there was even a single economic report telling us about the collapse in the economy. But you didn't have to be an economist to know that things were falling apart. All you had to know was that firms were beginning to shut down, that the virus was spreading, that state and local governments were shutting down beaches and parks and all kinds of stuff. And so you knew it was going to show up in the data. You didn't have to wait for the data to appear before people started getting fearful for the economy and the market started going down. And for the same reasons, the market started to recover before it was evident in the data, right? That employment report that you cited, Michael, a few minutes ago, before that came along, all of the data continued to show a very, very weak economy. And yet the stock market had already begun to recover. And that's because the market does look ahead. But you know, my line about this is it's kind of like the guy with one leg in a tub of boiling water and the other leg in a tub of ice water. And saying that on average, that person is comfortable, right? This is that kind of average. So if you're looking at, for example, technology-based firms, internet-based firms, Amazon, Google, Microsoft, Netflix, those companies were enormous beneficiaries of the shutdown and of the pandemic. People stopped going to the store and they bought everything on Amazon. People stopped going to movies and they watched TV and watched shows on Netflix, and so on and so forth. So everything technology oriented did extremely well and has actually set new highs. Amazon and Apple are both worth over $1.5 trillion each. And they carry a big weight in the S&P 500. So that pushes the S&P 500 up. Then there are healthcare companies that are beneficiaries and a bunch of others, supermarket chains and so on. All of those stocks did well. Then there's everybody else. And to one degree or another, everybody else got hurt. So there are those that were dead center in terms of the bullseye. So the airlines, the cruise lines, amusement parks, movie chains, all of those companies were dramatically and directly hurt, and those stocks got crushed. So the average of plus 10 to 20% and minus 20 to 40% gives you a net minus 5% or something like that for the year. And the average really is misleading. It's an average of two dramatically different parts of the economy performing very, very differently.
All right, so we've seen, the good, the bad, and to a degree the ugly, right? And this puts advisors, all of which are on this call, in a sort of difficult position, right? Answering this question. So now what, right? What does an advisor do? How do you position client portfolios? What is this recovery, stock market and economic, going to look like? So stock market, we've seen a V, right? We had the 1,800 point down day the other day. This morning opened a little ugly and then recovered. But for all intent and purposes, we've got a V on our hands. What do you think the economy is going to look like? And what next? What now? Where do we go from here?
Yeah, so I think the shape of the recovery is going to look like a distorted V. So the first leg was down dramatically. That's the downward part of the V on the left. The upward part is not going to be symmetrical with the downward part. It's going to be a lot flatter. And it's going to be more curved. So the initial bounce from the bottom will be quite strong, but how sustainable will it be remains to be seen, and it's not likely to continue at the same recovery pace at which it declined until we get back to where it was, right? It's going to be more stretched out. So initially it'll be strong because there'll be a lot of people who will be going back to work. And as a lot of people go back to work, that means that they're buying all kinds of goods and services. And so that provides a lot of impetus for recovery. But a lot of the impetus will then quickly wear out. And a lot still depends on what happens with policy. So the government knows that they've provided a nice fill-in for people who lost their jobs. They provided a lot of cash that enabled a lot of people to continue to pay their rent, to pay for groceries, for normal living expenses. But they've got to do more. There will likely be more stimulus policies, and what they are and how they're structured and what incentives they create matters enormously, because they can screw it up and discourage people from going back to work if they mishandle it. And they can also provide a lot of recovery potential by encouraging people to go back to work. So a lot depends on what they do. But my guess is that we're going to see an ongoing recovery. It will not falter, but it may not be as robust in 2021 as it is in the second half of 2020.
So effectively, you're thinking it's the elevator down and the stairs up.
Yeah, that's a perfectly good way to describe it. For whatever reason, we always take the elevator down, whether it's in the economy or in the market. When people respond to adverse information, they tend to respond very aggressively. If you think back to the recession in 2008, there was a massive decline in employment, unlike anything we'd seen before until this episode. And then the recovery was gradual and took a long time to play out. This time around, it was even more massive in the decline. I expect another solid rebound this time, but it will still take a long time to play out.
All right, so let's pause for a second because I do have some questions coming in. And this is a good sort of time to do that. If you have a second wave of any significance, right, what does that do to second half GDP? What does that do to estimates? You know, when you're bouncing off the bottom, does it matter how high you bounce? What's the thought process there?
Yeah, so you have to be very careful about what a second wave means. So I think one of the things we're hearing a lot of, especially from healthcare professionals, is they're warning us about a second wave. And I think part of the reason, part of the motivation for it, is they want people to be a lot more careful than they are being. And so they're trying to scare us into being more responsible, which is a perfectly understandable thing for a healthcare professional to do. But there are also a lot of changes that have taken place in dealing with this pandemic. For one thing, when the whole thing started, we were slow on the uptake to realize what was going on. And so we did a lot of things, the government did a lot of things, and people did a lot of things that put themselves at risk because we didn't know any better. Then we didn't have supplies of all types. We didn't have masks. We didn't have personal protective equipment for healthcare workers. We put people who were positive in nursing homes and didn't segregate them properly from people who were not positive. So we made some really bad mistakes, and it cost a lot of lives and undoubtedly contributed to a more unfavorable economic outcome. Well, things are a lot different now, and we do realize that all of these risks are out there. So when you go to the supermarket, when I go to the supermarket, half the people there are wearing masks, half aren't. I wonder about those who aren't. But the fact of the matter is, if there is a second wave come the fall, there's no doubt that it will take very little for everybody to start putting masks on. We also have, so we're finding all kinds of potential treatments for the COVID virus. Some of them are unproven, but I have no doubt with all of the research that's going on and all the drugs that are being tested left and right, and there are probably over 100 different drugs that are being tested for treatments, I have no doubt that some of them are going to prove effective, and indeed some have already shown some positive results. So all of that suggests that if there is a second wave, and I do think that there will be a second wave, that it's going to be much, much milder than the first wave. And hopefully with things like social distancing, which we did not do earlier, and with wearing masks and so on, that that the second wave will be much milder, and we will not shut down the economy. I doubt we're going to shut down the economy. It's more have to live with this virus, as you put it, Michael, and simply adapt our behavior accordingly.
All right, so with that, all right, let's start thinking about second half, potential volatility hotspots, things that advisors should be thinking about. So we just talked about second wave in the fall, and who knows if it's really a second wave, an extended first wave that never really ends. One way or another, right at 30,000 cases a day, give or take. We're either going to have a vaccine or it's going to make its way through the population, right? One way or another, this story has, some sort of end date to it. We just don't know what that is.
Yeah, but I don't think it's right to be that pessimistic. I mentioned more than 100 drugs being tested as treatments. I think there are 10 or 11 drugs, several of which are already in trials as vaccines. And, those who are really, really negative will tell you things like, well, we've never developed a vaccine before in less than about 3 or 4 years. And that's true. But it's also true that the technology for developing a vaccine has never been this good. Yeah. We are doing things today at a speed in healthcare that is just absolutely unbelievable compared to 5 and certainly 10 years ago. So I'd be surprised if we don't have a vaccine in 2020. I don't know that we're going to have enough medicines, enough of the vaccine to be able to widely vaccinate a lot of people. I suspect that will not happen in 2020. We just don't have enough time for that. But we should have enough. I'm guessing that we're going to have a vaccine in 2020, and it's going to be available to healthcare workers and maybe some who are really, really sick. Plus, plus medicines that we find do have a significant benefit for people who've come down with COVID, so that the number of people who die from COVID are going to be vastly reduced. Keep in mind that we contributed to the problem by putting people at risk in nursing homes and then putting people who were positive into those nursing homes. Well, that's not going to happen again. So there are a lot of things that are changing, and they're changing at a very fast pace on the fly. So I think that the economy is going to continue to expand. It could be that the pace of recovery slows down in the fourth quarter if people do start becoming nervous. But my guess is that we're going to plow through that.
Right. And if, not to draw it out, but if you think about the pace with which we can sequence, the DNA, the genetic DNA of this virus, it happened in light speed compared to 10 years ago. All right. So.
Yeah, well, 10 years ago, it cost hundreds of thousands of dollars, and it took 2 to 3 years to decode DNA.
Right.
And, a couple of years later, that cost was down to hundreds of dollars and a day. And now that cost is down to, tens of dollars, and you get the results in 15 minutes. So those are the kind of changes that have taken place. Today, we're talking about another whole approach that's yet different from the treatments that I was talking about, and also different from vaccination, is that they're also talking about taking someone's plasma who had the illness,
right,
and screening the plasma, getting out the antibodies, and using that as a treatment. Right, so it's unbelievable how quickly medical technology has advanced.
All right, so we have an interesting question here, a very interesting question. What do you think would be better for the market? Right? Do you think we need a vaccine, or do you think just case count has to go down to the point that it's no longer front page news? What if instead of 20,000 a day or 30,000 a day, whatever it was, that number went to 10,000 or 5,000, right? And it just wasn't front page news anymore, Is that enough, or do we actually need a vaccine?
Well, I think you really do need a vaccine to really fully get back to where we were back in, let's say, January or February, right? There's still going to be plenty of people who are afraid to get on an airplane, who, let's say, are afraid to get on a cruise ship for a vacation. Although it blows me away, the cruise lines and all kinds of other sources of information on this indicate that bookings for cruise lines for 2021 is actually increasing quite rapidly. So, people are mentally getting back to more normal activity a lot faster than I would have guessed. But nonetheless, I think to really get back to where we were, we kind of need a vaccine. But we also need to be, for most people, it's probably sufficient to see that the number of cases out there is really greatly reduced. And by the way, we're already down to 20,000 a day. But we do need to see it go lower. And as it continues to go lower, more and more stuff will open up. And as more and more stuff opens up and people do more and more stuff, that just reinforces the pace of expansion. So, and I think the market sees that. So as all of this plays out, I think the only thing that's out there that could disrupt this performance is the risk of a second wave on the virus. And right now, my judgment is that there is likely to be a second wave, but it's likely to be much, much milder than the first wave. And people who, for example, look back to the pandemic of 2008 or 18, I should say, 1918. So the last pandemic, when the flu came over after the end of World War I, people did not know how to deal with that at all. And so the second year of the pandemic was actually worse, cost more lives than the first year. That is going to be the mirror image of this time around. The second wave this time around is going to be a lot milder than the first wave.
So, again, with regard to investing, now we talked a little bit about rising tide, all boats. On the screen here, S&P 500 equal weight index versus the S&P 500. So if you add the S&P 500, which is dominated, right, like you said, by Amazon, Apple, Microsoft, those companies which have done very well, they weigh the most, so therefore they have the biggest impact on the S&P 500 versus an index that weighted everybody equally, a fully diversified portfolio. You can see the underweighted index has underperformed. My question to you, Chuck, past performance, future guarantee, that type of argument, can Amazon continue to do what it's done?
Okay, so one of the ways I'll answer that is to repose the question slightly differently. So we have two parts of the market, those that have benefited from the virus and those that have been hurt. And the average suggests that the market is down only a little bit, that we've largely recovered. Does that make sense? And I would say we need to look at the two separately. So take the companies like Amazon, Netflix, Google, Microsoft. Are those stocks reasonably priced for what's happened to them and where they're going in the future? And so a company like Amazon obviously benefited. A lot more people started using Amazon for their shopping of all kinds. And chances are good that's going to accelerate the shift from bricks shopping to online shopping. And so I think that the fact that Amazon has done very well makes a lot of sense to me. And I don't think all of those gains are going to be lost. In fact, I think most of those gains are going to be retained. And we've simply moved forward in time the shift from bricks and mortar shopping to internet-based shopping.
Right. You can agree that everything is pulled forward, say, 10 years, right? Netflix over movie theaters, Amazon over retail, whatever it may be, that it just sped up the demise of those companies. But if you were an investor, if you were an advisor, right, can Amazon, it's doubled over what, I don't know, 5 years, 3 years, whatever it is. I haven't looked into it. But can Amazon double from here? I mean, how hard is it to go from $1.5 trillion market cap to a $3 trillion market cap?
Yeah, that's the harder part, right? So I think that whatever market share Amazon has captured, it's going to keep. And it's going to continue to build on that market cap, on that market share. But the pace at which it does that is going to slow down. So the last couple of months are going to be extraordinary. It'll go back to a more gradual recovery or growth in its market share. And so that's the difficult question that you have to answer when you evaluate whether it's worthwhile buying Amazon today, right? The PE multiple is that much higher. That's true for Microsoft. Microsoft is trading at something like 10 times sales. So those multiples are very, very high. And I suspect the growth rate on those companies is going to slow down. It's not going to zero. It's not going negative. It's simply going to slow. And so I don't find a Microsoft all that attractive today. I think the much better values are in parts of the market where the companies got hurt, but the business was not damaged. And so as things recover and go back to normal, those stocks have the potential to rebound further. And that's where I think the real opportunities are in the market.
So would it surprise you entirely to see an S&P market return not be so great, right? Because you may not get extraordinary returns out of the largest companies, but the underlying stock selection, individual stock selection, right, picking and choosing where your battles are, you could certainly go ahead and find out performance there.
Yeah, in fact, looking at this graph that you have between the equal weight and the S&P, I think it's very likely that the red curve will go through the blue curve. So there'll be a period of time where the equal weight outperforms the S&P 500 because there's so much recovery potential in those companies that have been hurt, and there's upside, but less upside in the companies that have really benefited from what happened.
All right. So that being said, right, there are new elements that need to be thought of with regard to how companies survived. Now, with the Fed's announcement today that they're going to be buying corporate bonds, and you and I were sort of joking about it earlier, but sort of not joking about it, that the Fed has effectively nationalized the bond market. Take a company like Royal Caribbean. Right, they were able to issue bonds. Great. The company was able to do that to stay capitalized, stay alive. Fantastic. If you're an investor, though, who owns this, right, the question becomes how many more people need to book cruises in order to pay off a 9 1/8 coupon on the bonds that they issued? So I believe they issued $1 billion worth of bonds, 500 million in converts, and 500 million in this 9 1/8. But if you issued 500 million at 9 1/8, right, you're paying, a significant percentage of that in just interest. And so is it possible for companies to generate the same type of profits when they tap the high yield equity market, when they tap, not the equity market, the high yield fixed income market, the credit market, in order to generate or to raise cash, to raise capital? Companies may not, are they effectively swimming with an anchor? I mean, to keep with the Royal Caribbean, theme.
Right. Well, that's a fair question. And in the case of Royal Caribbean, the real problem is that they're losing money. They're losing a lot of money every single day. And that's what they sold those bonds to try to fill in that hole and stay afloat, to make a pretty annoying pun. But you took a big bite out of their capital base, right? So think about the cumulative losses over the period of time that their business was shut down. We're talking billions of dollars. That comes right out of the balance sheet, right out of the capital base. And it'll take a while before they can get back to a run rate of profitability where things were back to where they were. Because, unless the latest data are accurate, and maybe they are, that people really are booking cruises to a significant extent for 2021. But in my judgment, it's going to take a few years before people are really comfortable and the cruise industry is back to where they were. And I think this is an example of where having a vaccine would definitely make that feasible. And if you don't have a vaccine, then I'm less confident of that. But, so they lose a couple of $1 billion, and they now have to pay interest at a high rate on that couple of $1 billion that they had to borrow to replace the money they lost. So yes, this is an anchor on their business, but in terms of the recovery potential, it is there. It's just not going to happen overnight. You have to think in terms of multiple years, because this will not play out very quickly. It shouldn't play out very quickly. Maybe people will be will look farther ahead than I think they will. But that's why we're not that comfortable in playing in Royal Caribbean, because we think it's a longer term play. I'd rather look at something shorter term where I think the recovery potential can happen sooner rather than later. In the case of, if we were to get a vaccine, I think there are lots of parts of the economy that would reopen fully very, very quickly. And so, for example, take airline travel. So initially, we're probably going to operate at something like 2/3 of capacity, but a lot of the planes are still parked. But the airlines are already beginning to bring more aircraft back into service. So I fully expect there to be a significant uptick in airline traffic and airline usage. And those companies I expect to start becoming profitable a bit sooner than the cruise line space. And then you get to things like hotels. A lot of hotels can be accessed because people can drive. And, people will want to take a vacation at some point. Maybe they're not comfortable taking a cruise. Maybe they're not comfortable getting on an airplane and flying to Europe. But driving to a hotel, in California or in Florida or on the East Coast, those are all a lot more feasible and a lot easier to manage. And so I expect the hotel business to come back a lot faster than either the airline business or the cruise business. So again, you have to think about this in terms of each individual industry, each company, because they have different dynamics. And then beyond that, you also have to look at the financial wherewithal of each company. So within the hotel business, there's some hotel companies that are highly leveraged, and they may not be able to make it without having to basically give away a lot of the business to whoever lends the money in the future. And then there are others that are not very leveraged at all. And those companies are licking their chops and looking around for which hotels they may be able to buy because they're distressed and they can buy them cheaply and grab those properties. So this really becomes a battle in the trenches where you have to look at companies one by one by one. You start at the macro level and you look at industries, and then once you identify industries where you think there's recovery potential, then you get down in the trenches and look at the individual companies, because some of those companies in that industry will fail or will not do well because they're just not positioned to do well, whereas others are much, much better positioned and have recovery potential sooner rather than later.
I used to think it was debt that killed companies, and that may just not be the case, where with the Fed out here buying, companies may just not recover as quickly as they did. But, it sounds like companies have the ability to issue more debt to pay off existing higher coupon debt. And with the Fed out there buying, whether it's directly or through the ETF, they probably don't need to do so at rates they had to back just a few months ago. Okay, moving on. Too far, too fast. Quickly on this one, Chuck, what are your thoughts there? Has the market moved? And this is a very common argument, right? We're up 30, 40% off the lows. too far too fast, or did that make sense given the enormous amount of liquidity the Fed and administration poured into the system?
Well, look, you can never answer this question with any great precision, but I think a substantial rebound in the stock market made perfectly good sense, partly because I think, as the market always does when it goes through one of these things, it always overshoots. It overshoots to the downside, and it often overshoots to the upside as well. So back in 2008, the market was priced for the world collapsing. And so we got this massive rebound in the stock market in 2009. And part of the reason that the market rebounded as strongly as it did was because the market collapsed as much as it did. And I think we're seeing another version of that today. So when I look at current prices in the market, that's really the only way to answer the question. And I look at individual companies. So I look at an Amazon, and I see a company that has done very, very well, but is very richly priced. So I can make a case that it deserves to be richly priced, but from here, I don't see it as having significant upside potential. And then I look at other companies where I think there is a lot of potential for a rebound. So take some of the gambling companies. I think that those companies could come back a little faster. They're hotels plus gambling, and the hotel space should come back more quickly than travel. So I think that there's plenty of recovery potential there. And then if they're not carrying too much debt, then they really can recover and start making money again fairly quickly. And so I think there's great value in a sector like that. Well, so it really is a matter of looking at individual companies.
Well, not that I wanted to, hurry you up here, but the reason I wanted to say, on this one, move a little faster is because the next two slides are the most interesting to me of this presentation with regard to future hotspots and future risks for advisors and investors, right? Aside from COVID, aside from coronavirus, this has been percolating beneath the scenes. This was painful the first time around. Expectations here.
Yeah, so I have no doubt that the U.S. is going to continue to fight with China over trade. I think the truth of the matter is that access to the U.S. market is very valuable to China. It can't afford to lose access to the U.S. market. And so Trump, without a doubt, has a lot of cards to play to put pressure on the Chinese to buy more and more American products. They will fight tooth and nail, but that's only one part of the battle. The rest of the battle is more political and for global leadership. China is still 1.4 billion people. It's still developing at a rapid rate. It still wants to have regional power in Asia and ultimately to be on an equal footing with the West globally. And I think that is going to be a huge political issue going forward. Now, notice I use the word political because it's more political than economic. I see the world sort of breaking down into three major economic regions. China at the core of Asia, the U.S. Just because of sheer magnitude, sheer size, and then, of course, Europe. And each has its own interests, but I suspect that the political battle between China will spill over into other areas like technology. We may end up providing more support for technological research in this country, for R&D, for technology, because the Chinese sure are doing the same thing on their end. And that's going to continue for quite a while. In terms of economic growth, it's not going to prevent either country from being able to grow.
So, with regard to this for advisors positioning portfolios, worth looking at, what happened the first time around and revisiting those names and just recognizing that this is still out there. You mentioned politics, right? We don't, okay, Main Street Pain, even before we get there, I forgot about this slide. Let's move forward just because, right, here we go. This is the one because we're getting close to the end of the day. Blue Wave. Let's talk about the implications here, which could be significant in the event the Democrats sweep in November, right? We have no idea. We're not taking a side here. We just want to be prepared and thinking about it in terms of it happening. So the House, the Senate, and the administration. It's likely in that scenario that tax cuts, corporate tax cuts go away, right? They're raised maybe back to where they were. And with that, right, companies that really benefited may not make as much money, right? And you can see baseline forecast of earnings per shares 2021 on the S&P 500 goes from 170 to 150. It's a big haircut in the marketplace. A 12% reduction in earnings. What type of impact does that have on investors?
Yeah, well, that's one of my big fears. Now you're dealing with something that could well happen, and it will reduce corporate profitability. And if it reduces corporate profitability, it reduces the value of stock prices. So, yeah, this is a real risk. As far as I'm concerned, we're thinking about how to play this in order to reduce our exposure. That includes looking at offshore investments, ADRs, and stocks that derive most of their profits from foreign countries. But this is a concern, and it's the mirror image of what happened when Trump was elected. When he ran and argued that he was going to cut corporate tax rates, and most of us thought that he was unlikely to be successful at that. And then in very short order, he managed to pull it off. It was a big surprise that he succeeded in getting it done. And it had a huge positive impact on the stock market because corporate profits increased pretty sharply. If you get the reverse of that now, no doubt it would have an adverse impact on the stock market. Prices would have to adjust to a lower level of profitability. It's just the math of it.
So worth looking at the companies that benefited the most. With that, though, this isn't the only tax that could go up. If Democrats won, right, they've made no bones about the fact, Biden has made no bones about the fact that capital gains would be going up. If they did, do you expect there to be a sell-off or people to sell the winners this year before the end of the year? The Amazons, the Microsofts, the Zooms, the things that have done really well, because if you planned on selling them at any point in the next year, it's likely that you're going to be paying a significantly higher capital gains tax. Does that add to selling pressure?
Sure. And, it identifies where the selling pressure is likely to be, right? It's all the stocks that have done the best, that have the biggest capital gains, where the selling pressure is likely to be the greatest. So it's tech, it's healthcare, it's some of the consumer staples. Those are the companies that benefited from the COVID virus, and that's where the prices are most at risk.
Last but not least, I wanted to end here with the idea that obviously companies are going to survive. A lot of companies are going to survive. There are going to be some that don't, but a lot will. And the things that you should be looking at as an advisor when doing your research, when looking at specific companies to buy, are here on the screen. These are the things that we're looking at: balance sheet analysis, debt maturities, dividend coverage, income statements, cash flow analysis, and government intervention, right? These are things, just some of the things you should be looking at when positioning client portfolios, because the rising tide no longer lifts all ships. With that, wanted to go ahead and throw my email address up here on the screen so that people can reach out to me for anything that they want. We do have a couple questions here that I wanted to get to, but as we come upon 5 o'clock on the East Coast, we can see that people are starting to, sign off. Wanted to get my email address up here again so that if you have additional questions, if we can help with portfolio case design, if we can help with third-party asset management, feel free just to ping me, hit me with an email. We'll get back to you extremely quickly. Obviously, we want to be able to help you, your practice, your clients, so on and so forth. Couple more questions worth getting to here. Growth over value, Chuck. Value going to make a comeback? We've heard about this forever. Still waiting for it. It's like growth.
Oh, it's already started. So a couple of weeks, I think it started a couple of weeks ago. We saw a big relative movement in value compared to growth. And the comments that I made earlier suggest that we should see more of that. So when you think about the companies that have done really, really well as a result of the virus, a lot of them are growth stocks. It's Google's, it's Netflix, it's Microsoft. The value stocks are the ones that were really more in the way of the pandemic. They underperformed, they got crushed, and yet those companies are not going to go away. We still need still need all of the products and services they produce, and so we do think that value is going to perform much, much better relative to growth, and it's never one or the other strictly, but we think they will do better.
What about income-producing securities, right? You have the Fed in here buying bonds, buying go back the other way, buying mortgage backs in the muni market, all over the place, right? The Fed has stabilized things. With rates being low, right? Does that put pressure on income-producing securities?
Yeah, ultimately, it starts driving income-producing security prices up. In the short run, part of what's happened is that not only did investors panic beginning in February and March, but so did corporate treasurers. And so a lot of companies cut their dividends or suspended their dividends. In some cases, they had the ability to pay those dividends, and they chose not to or to cut back just because everyone was nervous and everyone was fearful for the future. And if you're a corporate treasurer, the first job that you have to focus on is to make sure your company can survive. So a lot of companies drew down credit lines, they cut dividends, and a lot of it was done with discretion. In some cases, we've seen companies already repay their credit lines. We've had a number of companies that we've looked at where they've already done that. But going forward, obviously it depends again on the company and the business that it's in. So companies can't pay dividends if they don't have the cash flow to pay them. And so again, it reflects what's happening to their business, how much has their business recovered, how quickly does it recover, and how quickly can they feel comfortable restoring dividends that have been cut or raise dividends that are already being paid. Again, it's company by company, but we think that as the economy recovers, corporate profits will recover. That's why the market has rebounded, and therefore we think in time, so will dividends as well.
I saw just on Friday, I believe it was Friday, that Dick's Sporting Goods reinstated their dividend after cutting it. So that's right, things are on the up and up.
That's a perfectly good example. And we'll see more of that sort of stuff, again, as the companies themselves get better clarity on how their businesses have fared through this whole process. We're seeing the same thing, for example, in shopping centers. So it's kind of interesting. Initially, shopping centers did very well because a lot of shopping centers have a supermarket as the anchor. And so everyone was going out and stocking up on toilet paper and Cheerios and pasta and basics, so-called pantry stocking. And then people started realizing, wait a second, what about all the other stores in the shopping center? So the hair salon, the barber shop, the dry cleaner, those guys were shutting down, and now they're hurting. And so they may not be paying their rent. And so again, people started looking at the shopping centers and realizing some of those guys are going to take a significant hit to their revenue, and they may not be able to pay out their dividends. And I would say half the companies that I look at in that space have temporarily suspended their dividends completely, and others have maintained theirs. And again, it reflects the mix of tenants that they have how stable their business is, how much at risk their business is. But we're already seeing business resume, pick up again. And so more of these shops, the little local guy will reopen, the hair salon, the dry cleaner, and so on, and they'll start paying rent again. And they may cut a deal with the owner of the shopping center to basically pay the rent that they didn't pay over an extended period of time, or maybe they'll extend the lease. But the shopping center doesn't want the tenant to go bankrupt. The tenant doesn't want to go bankrupt. He wants to stay in business. And so those kind of things get worked out, and then the revenues start flowing again, and then we can very quickly go back to having those companies pay out those dividends. So there's an example of a sector that I think will come back sooner rather than later, and will be in a position to restore dividends sooner rather than later. Okay. And in the meantime, you look at the bond market, and interest rates are extremely low. So we see, 70 basis points on a 10-year treasury. We see 100 basis points, 200 basis points on a high-grade short-term bond. You really have to get into junk bond territory before you can get any real yields. So the bottom line is that stocks that pay good dividends, that have some growth ahead of them for years to come, they're in a great position to attract capital, whether it's a McDonald's or a supermarket or a Kroger or Procter & Gamble or any of those kind of companies. Those businesses are not going away. They're still very cash flow positive, and they have the ability to increase dividends gradually over time.
Okay. Let me cut you off there. We've gone for more than an hour. Chuck Lieberman, Chief Investment Officer, Mike Lieberman, Key Account Manager. We're just a small part of a team that is fantastic in terms of trying to work with advisors to provide better solutions to your clients. If we can help with anything, feel free to let us know. Again, you've got my contact info. Chuck, thank you. Thank you, everyone, for being on today's call. Sounds like there's more to talk about, and we will have more webinars in the future. Thanks, everybody.